All right. What is going on, Hot Take Nation? DRW here for another episode of the Hot Take of the Day podcast. Today, I'm very fortunate to be joined by Rob Turnham, who is with Goodrich Petroleum as the president. And obviously, he's the better dressed of the two of us. The white shirt, pink tie is very, very solid as opposed to the Hot Take of the Day wear. But, we like to vary it up here. So, Rob, welcome to the show. Thanks so much for joining us today.
Thank you, David. Glad to be here.
So, we're going to cover a lot of topics today. And for those who don't know Goodrich, it's a really interesting story, I think, over the course of time. So why don't you walk the listeners through just to help sort of orient them with where you were and how you got to where you are today?
Sure. Well, we've been a public E&P company for 25 years. We've seen numerous cycles throughout that period of time. We've been on the New York Stock Exchange that period of time. We have evolved from a conventional player where you didn't frack wells to unconventional, vacillating between natural gas and crude oil, depending on where commodity prices were. And thankfully, we have legacy positions in a couple of basins, one of which right now is the Haynesville up in North Louisiana, which is 100% natural gas. It's held by production because we've owned it since the early 2000s. And has gone through an evolution such that the economics in that play, even though it's in a natural gas basin, are probably as good as any play, not just natural gas basin, but any play, including the Permian. And it's a result of really better stimulation practices, higher proppant concentrations when you frack your well, tighter frack interval spacing, generating 2.5 times the results that we used to see back in generation one of the completion recipe. And so much more productive wells. And by virtue of oil prices decreasing, we've seen a drop in service costs because of inactivity. Both the rig count dropping to below 300 and then the frack crews that are actually fracking wells has dropped dramatically, probably 80-85% from the peak. So it's a unique situation here where if you look out into 2021, a look at the screen currently, it's about 263, which is a good bit higher than the prompt month. But it's creating a margin that we've not seen before, even when gas prices were north of $10 an MCF, because service costs have dropped so dramatically and the wells are that much more productive.
So it kicks us off on a couple of topics in that. So we'll start with natural gas because we don't talk a lot about natural gas. I had done a post in, I want to say it was around September 2019. I think I called it natural gas burnout. And at the time, oil looked to be, even if not growing, certainly flat. And the average GOR of an oil well is 4,000 to 5,000. So, as we decline with oil prices, we were taking 15 to 20 BCF a day off the market. But when I looked at it in September and that oil-associated gas decline didn't look like it was there, you could certainly see the improvement in productivity in the Haynesville has been so marked. And as you said, the forward months look kind of be 250 versus prompt at 160. Other than just is there more evolution technology-wise that you think can continue to unlock the Haynesville, or is it simply a matter of getting the right price now, both the price of service companies and price of the commodity to be able to really let that position shine?
Sure. Yeah, great question. So it's really interesting. It's the first basin that we've ever been in where we have a consortium of operators who are sharing ideas, both on the drilling side and the completion side. The land grab has been over for quite some time. Now we're all trying to optimize, get as much gas out for as little money as possible. And so we have experimented quite a bit with completion methodology. And in fact, I like to say in this industry, technology is really, amazing when you look at how it's changed over time. But we also have a lot of trial and error, and we use what we think may work and then test it out. And then if that doesn't work, you pivot and you do something different. So by virtue of a number of operators being involved in this, we've been able to evolve into what we think is optimal completion technique. Now, there's a high correlation. If you do linear regression and you look at proppant loading, so call it sand per foot or proppant per foot to EUR, what your reserve ultimately will be, high correlation, like 82%, an R square of 82. So very high correlation, but what we're really interested in is rate of return on the dollars being spent. And so instead of pumping 5,000 pounds per foot, for example, and getting the highest EUR, we've dialed it back to closer to 4,000 pounds per foot, because we're still getting something similar on a reserve standpoint, but we're spending less money, and therefore our rates of return are higher. So, you never say never on improving your recovery of gas or oil in place through better technique, but it feels like we've kind of jumped all the way out to a really high proppant loading and dialed it back to get to what we think is probably optimal.
Yeah, and I think that's pretty typical of the oil plays as well. And certainly as operators now really focus on rate of return and spacing being the delimiter there. When I think about the Haynesville early in my career, and one of the limiters was the depth and sort of the view of high crushed sand ceramics versus white sand or in basin sand. What's been the evolution on sand and as things have been depressed? Are ceramics now at the point where they're cheap enough to pump? Do you continue to pump them? How do you view the sand quality as a factor of EUR?
We were one of those companies that bought into that thesis, and we ran a science project where we were comparing 100% resin coat or ceramics. Those were similar. Resin coat was a little cheaper than ceramic proppant at the time that we ran this test, but again, you're using something that's artificially stronger. And we did that next to a well that was 100% sand, and we saw no difference. The thesis was that you needed it because it's overpressured and you need to keep your fractures open. But what we have seen over time is that the sand propagates it clearly, similarly to a higher cost resin coat or ceramic. And therefore, even if you have some crushing or less production 5, 10, 15, 20 years down the road, it doesn't matter relative to a present value of your investment. So we are all pumping. And then we went to Northern White because it was more regular, circular, more consistent. But again, similar, we need to prop open those fractures. And it was more expensive than local sand, but we ran tests there and we saw no difference in productivity on the local sand versus the Northern White. And so by virtue of that, everyone in our basin in that consortium is pumping local sand. And we're seeing similar results as long as you're in the core, and it's a fairly small geographic area, the core is. And as long as you're in that area, you're seeing something consistent by operator, as long as you're pumping the same frac interval and the same amount of proppant per foot.
Well, let me run something by you. It was an observation that I had when I was with Enerplus in the Bakken in 2009 through 12. We were using a high gel load, so it was sort of the old style sleeve completion because you couldn't get plug and perf. Because it was so busy in the Williston in 2011. If people who are new to the industry can even imagine what that was like. And we were pumping a high gel, like a 40-pound gel with 300 pounds per foot of ceramic. And as I looked at the results of those wells relative to the EURs of wells in the future, they're very comparable. Now, of course, the flowback techniques and IPs were different. But what I sort of came to was the ceramics, you can get away with a much lower pound per foot because they don't crush. And so I don't know if the ratios, like if you're pumping 4,000 pounds per foot of white sand, you might be able to get away with 1,000 pounds per foot of ceramic. But in the hustle and bustle of 2014 through 20, as we're trying to evolve and trying to tell our story to the analysts, people got so focused on pounds per foot that there really wasn't a lot of testing of lower concentration, better sand. Do you agree? Do you agree with that? And I know gas plays are different than oil.
Sure. There's some lesser concentration if you use a resin coat or a ceramic. No question about that. It's just the cost of the resin coat or ceramic versus the local sand was still so dramatically different that when we looked at building an AFE, even if we went, now we wouldn't go down to 1,000 pounds per foot versus 4, but perhaps it's 2,000 versus 4,000. That delta, call it, basically as long as your white sand is half as cheap or less, then you were better off going the white sand. In this case, it's probably 5 times as cheaper than the ceramic or resin. So it wasn't even close. And by virtue of pumping this higher proppant, tighter frac intervals, and again, same correlation on interval spacing. If you're too wide, 300 feet, like we used to be in generation 1, you're pumping, back in those days, we were doing 1,000 to 1,100 pounds per foot over a 300-foot interval. Well, now we're 4,000 pounds over 125-foot intervals. Same number of perforations within that stage, a lot more proppant, but we're getting 2.5 times the result, 2.5 to 3 BCF per thousand versus 1 to 1.1. And because service costs have dropped so much, the margin expansion is just pretty dramatic. So what we used to say was, you used to drill 5,000-foot laterals. Well, put 2 of those on top of each other. That's a 10,000-foot lateral that we drill currently. And whereas the cost used to be $7.5 million for a 5,000-foot lateral, so 2 of those would be $15 million. Well, that well cost right now is $10 million if you drill a 10,000 foot. So, we've shaved 1/3 off of the well cost, and we're getting 2.5 times the result. And so we're generating north of 100% IRR at $2.50 gas. Now that's a bit of a dilemma, because if gas prices do move to the current strip of $2.50 to $2.75, then service costs are likely to follow. Now there's, as you know, David, there's creep, and it's a lag. Doesn't happen immediately. And it does depend on where oil prices are, because the Permian will suck back a lot of the equipment that's currently not running. And therefore, at some point, costs have to creep back up because they're not making any money. For example, at the peak, we were fracking our wells at 110,000 per stage. They're less than 30,000 per stage now. Yes, we're using local sand, but it's the equipment also that's just been slashed dramatically. And so even when, in the old days when we were getting north of $10 per MCF in the Haynesville, we were only getting 1.1 BCF per thousand, and costs were higher. And so our margins were much less than they are currently at a $2.50 gas price.
So let's talk about that, because there's 2 pieces. Let's talk about first hedging, and you've said Goodrich has been public for 25 years, so 1995. You've been through the cycle in 2000 that sort of coincided with the tech bubble, the 2004 to 2006 Chesapeake-induced natural gas rage, where the gas shortage drove gas up, and then the gas excess drove gas down. Then 2008 really to 2014 with the Bakken, Eagleford, tail end of or beginnings of the Permian. You were exploring the Tuscaloosa, so you've seen all the cycles. Right. And hedging has gone from the best idea ever, really, when I started my career in the 90s. But then for a lot of reasons, it sort of came out of favor, because investments analysts and brokers and advisors wanted to own like a pure play, and they wanted to be the ones to manage commodity risk, not companies. I feel like our industry really moved away from it. And then really what happened this year in 2020 has sort of brought the eye all the way back full circle to hedging. So how do you view your hedging program, where your book is and where you think you want to bring it? And how do you think the industry will adapt to a hedge versus no hedge go forward in the next 5 years?
That was really well said. And frankly, it's because the industry and investors in the industry have moved from speculation to preservation. Which companies are going to survive this pandemic, which is just a real demand destruction, obviously, that we've not seen in a long time, and take some of that volatility out of commodity prices. And so the fact that we have less capital available, whether it's banks becoming more conservative, high yield market only being open for a select few, and certainly equity markets in essence closed unless you're willing to take some huge discount. So all of a sudden, much less access to capital. Therefore, any sliding of commodity prices puts the company in stress. And with banks in particular, more conservative anyway, they're risking their price decks, they're risking your financial models such that their advance rate, even though technically advance rate would be 65% of PV9 at their price deck, it's really not that when you start looking at what it should be versus what ultimately your borrowing base is. And yet they'll use your hedges in calculation of a borrowing base. So you're taking away some of that bank sensitizing as well by adding some hedges. But frankly, none of us really know where commodity prices go. You do your best to get as much information as possible, come up with a conclusion, and then figure out what's the right balance. For us, it's like 50%. If you can hedge your downside by 50%, and we like swaps. We don't like knockouts where the ultimate floor is lower. And you saw some three-way hedges that actually got knocked out because they went below the low end of that three-way. We just think protecting the capital that you're going to spend with an appropriate percentage hedge, and historically we've been 50 to 70%. Right now we're 50%, because we do see 2021 getting better on the gassy side, as long as oil prices stay range bound. Now, if all of a sudden oil goes back to 50 or $60, then that associated gas comes back, and then we'll see where we go. But lack of capital, high volatility on commodities driven by things out of your control. Who would have seen the destruction on demand from the pandemic? And then just again, lack of capital in case you get into a bind. Where do you go to fix the balance sheet? And so, yeah, it just feels prudent. Now, if commodity prices run, I don't think you can be 100% hedged at a price that's currently on your screen, because you do take away the upside for investors. But when investors comprise 2.5% of the S&P 500, and there's a lot of machine trading going on with ETFs and quants, then it just doesn't make as much sense to leave the exposure there, because the hedge funds are there's just so much fewer hedge funds that are speculating in our space that used to be.
Yeah, and it's interesting. Like when you talk about the disconnect between right now, I think the ticker would say $1.60 for front month of natural gas, which clearly, and you can look at Antero as an example. Their cost before they've even drilled a well, produced a well, compressed a well, operated a well, just in terms of firm transport and ad valorem tax, is $1.95 an MCF, and we're trading at $1.60, which makes it very hard. But as I'm sure you do, when I look at a $2.50 flat in 2021. Just gut says, boy, that looks good. You really want to hedge that in. But to your point, if oil comes back, gas does something different, service costs really rebound. So it is a complicated one, and it will be interesting to see how some of these, especially the majors that haven't historically, and people like Continental who haven't historically hedged, as normalcy returns and demand returns, to see what they do with their hedges and what banks do with their hedges. It'll be interesting to see. Now, the second piece of that was cost. And you talked about the service companies you'd expect will, since they're not really making profit, and we can see that in their quarterly reports and the layoffs and the closing of offices. So you'd expect that their costs would come back. Do you think that the time has come to reevaluate a fuller supply chain, similar to an Amazon, where they now have the Amazon trucks and they have their Amazon brand and sort of control all of it, so that as prices come up, you're capturing it, since there will be so much surplus equipment? Do you think the industry will move to that, or is that sort of question put to bed with units?
Yeah, I think the bigger the company, the more capable you are of vertical integration of your whole supply chain. EOG does some of that. The problem is each of those businesses within your total, soup to nuts, is a different model, and it requires manpower, not just to execute, but to administer. And it's not the same discipline running trucks to deliver sand as it is drilling wells and figuring how to turn your wells on. So I think there's so much focus on G&A right now, and trying to get as lean as possible. I don't see it happening anytime soon. Now, in a good market where you're worried about trying to shave cost as much as you can, but prices are good and you see service costs escalating, then to me, trying to do a cheaper version of a soup to nuts probably makes sense. Right now, just the overhead that it would take to administer that, when you're seeing bids that are just historically lower than we could ever imagine to provide the services right now, just seems like you're better off, at least a company of our size, just looking to third parties, because frankly, they're just trying to keep their iron and their people working, and they'll bid as low as they think it takes to get the business. And so we don't think it's worthy of doing that, just right now. But we'll see down the road. There was a time where you couldn't get trucks to deliver your sand, and now there's too many trucks. Everybody that gets in the trucking business will tell you that it's just feast or famine, historically.
Our industry is so capitally efficient, and I think people from outside the industry don't realize how fast we address things. And when we were at One Energy and we first got in Lee County, New Mexico in 2017, and we were drilling our wells, there was no water options. And within 12 months, we had 5 separate companies, and water prices had collapsed from sort of $1.75 a disposal barrel to kind of in the 50-cent range. So when there is opportunity to deploy capital, our industry does it very quickly and tends to solve it.
Yeah. Another great example, David, is saltwater disposal and trucks. If you're in an oily play where you have formation water coming out in addition to your frac fluids early on, and you have a high volume of fluids, then again, trying to work on your LOE, because saltwater is a big piece of your LOE, kind of makes more sense. In the Haynesville, we have no formation water, and we only see probably 25 to 30% of your frac fluid that you pump come back to us. And as you know, a gassy well, you basically frac it, put it in the pipeline, and you have a guy just make sure that it's still running when he drives by, every other day or whatever. It's just so much easier to operate.
So much easier to operate. I think people forget that, really, when in the excitement around oil and not thinking about, in the horizontal wells, how do you drop a pump 800-900 feet so that you can get that last head off the reservoir? And then as you're more deviated, you're having rod parts or running huge electricity. There's so many more challenges, and that natural gas is a much simpler operation. And so the bear thesis of natural gas really reverted to the bull thesis, and puts you guys in a good place. Now, you touched on G&A. How did Goodrich, sort of during the COVID pandemic and the downturn, how did you sort of think about that with employees, and how are you thinking about that go forward, both in terms of headcount, but creative ways you've solved it and kept employees? Because obviously you've been a long-standing company in the oil and gas industry.
Yeah, we were pretty lean going into it, just out of necessity, basically, because gas prices, as you know, it's been a long time since we've seen a dynamic gas market. So we felt like we needed the critical mass here to execute on a plan. Now, we spent $100 million last year drilling wells, all in the Haynesville. We'll spend half of that this year. And through attrition, our headcount has shrunk over the years by 50%. Now, when the pandemic hit, we were already 50% fewer people than where we had been not too long ago. So we were able to basically just hunker down. We shut the offices down like everybody else did for a while. We've since been back, but we're staggering shifts. We'll have a Monday, Wednesday, Friday shift and a Tuesday, Thursday shift with a nurse checking you in when you come in. And so we feel like it's a prudent way. And yes, you can be efficient away from the office, but we just feel we see some real benefit to having people getting back into a routine, doing what they do best, which we think there is some interaction necessary. And we're not having meetings. We're not doing a number of things that allows us to keep the social distancing. But from an overhead standpoint, and we think you're likely to see some cost savings anyway as we rebid out everything that we do. And it's going to really affect the office market, here in Houston. I mean, I think you realize now that you don't need quite the same amount of space that you had before. And so I would not want to be in the commercial office building business right now.
It's interesting that you say that, because I mean the real open question around demand, and I think we think about it from an electricity standpoint. So obviously natural gas is I think it's around 40% of the electricity generation in the United States. So as a demand for electricity evolves, so too does demand for natural gas. And we have all these office buildings. So we have this part-time, we have shift work. It's a very evolving business model. What would you say was the biggest surprise to the pro side of work from home? And what would you say was sort of confirmed on the con side of a work from home view you may have had before?
Yeah, I think on the positive side, and when you look at it from an accounting standpoint, there's a lot of invoicing and, running your ledgers and books and whatever that you can do that seamlessly away from the office. I would have thought, you needed interaction between account payable people or receivable people or division order people or whatever. And it basically has been seamless, which is a positive. And we were able to put our financials out in a timely manner with basically no hiccups. So I would say that part was we were pleasantly surprised. On the other side is deal generation and reviewing opportunities, having at your fingertips maps and things to pull out that would help you in evaluating opportunities. It's just difficult to do from home. We probably could do a better job of electronically filing everything that we have, but over the years you just have certain work maps that you are comfortable using, pipeline generated maps and stuff like that, and it's just easier to kind of exchange that information over a conference table than it is from your home office.
Well, and I think everyone, there's obviously proponents of work from home for a long time. I do think that everyone now has experience with Zoom, and they realize that some of the nuance around in person, the tool just isn't good if there's a real heated discussion, and not negative, but where lots of people are trying to get in. And I think the distractions from home, one of the things I don't really talk that much about, I've alluded to it in the past, but when we started One Energy Partners, the 4 partners were actually in different cities. And so the way that we managed that was we had a video conference call pre-Zoom, but we just sort of were on camera all the time, so that if you wanted to talk to the person, there was a poke app, and it was hey, Rob, let's have a chat. And then you could go to a side room or you could chat. And that was the way we did it. Right. But you get distracted when you're at home. The kids are coming home from school, or, your wife's coming home and you had to do the gardening and you forgot. So there's definitely a level of productivity that we found probably wasn't as high. But the trade-off was you weren't commuting and you weren't flying. So it will be interesting to see how the world really evolves to this. And I read an article today that said WeWork has started talking to New York City private schools about potentially leasing out some of their space for students. And I don't know if it's necessarily a socially distanced thing, but I certainly have thought about the office towers in Denver that are going to be vacant and the ones in Houston. And it's how do you repurpose those to, does that replace the infrastructure of old schools? Does it replace the infrastructure for housing and low-income housing in some manner where you stagger, and it'll be interesting to see.
Well, do you need the same amount of urban residential development if you're not commuting like you used to? So, what the whole purpose was restaurants, are those impaired? Bars, certainly, it could change everything from an urban planning standpoint. Clearly. However, there's no question, at least in my mind, there's benefits to social interaction and having conversations in person with people and sharing things in people. At some point, this distance, socializing has to end. And I don't know, people's psyche and the way they feel about themselves, certainly affects both mental and actual health at some point in time.
Yeah, absolutely. So one of the other things that you sort of alluded to in the conversation around like pricing and Haynesville and deal generation is one of the things that didn't really necessarily, you felt like that was maybe a weak point. How would you address consolidation? And to that point, you weren't able to have data rooms. You weren't able to have your BD guys go to NAPE. You weren't able to do the same level of generation that truly is required, like sit down, shake hands, look at a map. How do you think consolidation in the next 12 months happens, given equity prices, debt levels, commodity price? Give us a projection on what you foresee.
Well, certainly everyone uses virtual data rooms, now, so you can access all of the information. But sitting around the table and discussing valuation, discussing financing options, meeting with bankers to discuss financing options, if you're not able to go and sit down with them, it's just not as easy to get financing if you're doing it via Zoom or over the phone as it is, sitting at a table, meeting their risk guy, meeting their credit guys, talking through a transaction. So I think it will impair or at least slow down the ability to do things promptly. But I don't think it stops it. I think what stops it is the bid-ask spread by virtue of the fact that the buyer can't access capital as easily. And, these PDP buyers, you're going to find at some point, you're going to find guys that just aren't willing to sell just for PDP. We got to have some value for the undeveloped acreage. And so I think that's why you've seen a slowdown in transactions. And then what prices do I use? I mean,
and do the banks require that you hedge the price? So then you hedge away all the upside.
No, and I think they will.
I do
think
too.
That's where we're getting is like a bank who's not really making a lot of money on RBL. They can't afford to take much risk. And in fact, you've seen in restructurings, even the DIP financing getting impaired in a transaction or two, much less the RBL. And in the old days, that never happened. The credit was risked enough to where, they were always safe. It was the unsecured debt and the preferred and the common that ultimately stood to lose. But that's changed. And then you've got the anti-fossil fuel crowd that's putting pressure on the big banks, quit lending money to fossil fuel companies. So I just don't see the capital in private equity money, which there's still plenty of that on the sidelines, but their LPs are putting pressure on them to, hey, return some of that capital. We're getting pressure, from our investors to not invest in certain things. And of course, the old model of put the money in, put the acreage together, and then flip it to someone, that's been busted for a while. Companies aren't getting the valuations that they anticipated. So everything has changed. I mean, I think this has probably been the most uprooting of short-term periods that we've seen in our industry. And of course, unheard of on this pandemic. We got to get to the other side of the virus, get the demand back, and then start to figure out, what capital is coming back into our space.
Yeah, and I think you phrased it really well in terms of setting up the challenges for each of the constituents. How do the banks who loan the money to provide the capital, how do they actually even do that at a price deck? And then how do the PE guys lean in? And then how does the seller? All of those challenges are there. And so to me, as I look at consolidation on the back end of this pandemic, I mean, I think the first wave, so I'll ask for your opinion on this, is it's got to be public company to public company that have a similar debt structure, similar valuation, similar potential location, and some real synergies just on the G&A side, where those companies come together as sort of the first wave. And that helps extend the runway, maybe get a little bit better on the debt, maybe allow some creditors, which will be my question follow-up, but allow some creditors to convert into the equity. Do you agree that that really is probably the first wave that says, hey, the market's back and life is returning, or is there just too much political and cultural issues at this time to merge because prices used to be 10 times higher?
Yeah, it's an interesting question. So, I'll give you an example, and it relates to us. Our debt metrics were 1.3 turns on debt to EBITDA, so very low leverage. If we look at the other players in the Haynesville and we go, it makes sense to consolidate in the Haynesville, bigger company, reduce your G&A for the combined entity. It's hard to find someone that's below 1.5 turns. Good companies, good acreage, doing well. So are we going to combine and then lever up for our shareholders just by virtue of just, adding acreage, whether we're the survivor or the one that's selling or walking away? So we're all about maximizing shareholder value, but finding that perfect consolidating candidate is sometimes a challenge. Do you go out of basin? There's been a time where multi-basin was in vogue, and then in basin only, pure plays were in vogue. That's another challenge. But I do agree with you that it's easiest when it's public to public, because another weakness of ours is float. We're 6 of us own 56% of the stock, and so by virtue of that, we all see where we're going. We see value creation. I mean, we're still trading at less than 2.5 times enterprise value to EBITDA, so extremely cheap. Normally, you trade like that if you've got a bad balance sheet. Well, we got a pristine balance sheet. We're generating 12.5% return on capital employed, which is top 4 or 5 in the whole peer group. But it doesn't seem to matter because we have low trading volume by virtue of just high inside ownership. So how do you solve for your float? How do you make this thing trade better? Well, if it's another public company that you're combining with, you have a history there, and you can say, hey, if we combine these two, it makes sense. It ought to trade at a better multiple because of scale, lower G&A, and the balance sheet on the hindsight is okay. The flip side is if you're a public and you're combining with a private guy, in particular, if the private guy's bigger and he's got a PE sponsor who really wants out, that creates an overhang.
Like Comstock Covey Park as an example.
Yeah, and they were creative there, and it was a great transaction, I think, for both of those companies. The valuation made sense, and they knew that they needed to do something. But if you go with a different PE-backed company who really wants out, then you create a bit of an overhang, and they've got to be locked up for a period of time. But what happens if you haven't solved for the float issue and you've got a big sponsor who needs to get out? So there's just a lot of challenges out there, when you look at, how best to scale up. The biggest challenge, though, is just to not put the balance sheet in a bind by levering up.
Do you think, I mean, it makes me think, because I think the Comstock Covey Park one, again, I think it worked out really well. It was Jerry Jones who was trying to roll in, obviously, the existing Haynesville assets that he had, plus some Bakken wellbore deals he'd done, right. Combines it with Denham, who really needed an out. And so it's basically a private company with a public float, because I think Denham owns like 15%, Jones owns like 84%. So the float's very small. Right. And then they issued some bonds today, or they're asking to issue some senior securities. And the interesting thing was the interest rate's 9.75%. And so the question, I guess, to you is, with how much things have changed, that the old models didn't work, the old just drill and flip, the old get as much proppant as possible, all the things, are management teams equipped with the current personnel that they have in some of their management leadership positions to actually address the challenges that we have as an industry? Which I know is a bit of a loaded question, so I'm not asking to be specific, but it took a certain thing to get to the top of company XYZ. And then everything in the last 6 years is totally blown up from what that person had seen in their career. What do you think about that? And is that part of the reason that oil and gas hasn't really been able to face the climate challenges and face the anti-fossil fuel et cetera? Or is that just a bigger issue?
Well, no question. We need to do a better job of defending fossil fuels and talk about the benefits of fossil fuels versus just the downside to fossil fuels. Alex Epstein, in his book, talks about you need to look at pros and cons of fossil fuels as compared to other sources, not just the downside. Because we've fed so many more people. It's just the world is better off having fossil fuels and the greening of the world through some amount of global warming. But I think if you're leading a company and you're not keeping up with current issues, and I think most C-suite executives are, or your days are numbered if you're not. To your point, so I think they are. It's just been a very challenging environment when you look at we're a victim of our own success because we're making more productive wells and we're deploying capital, and therefore we've created an excess supply. It's been good for the world. It's been good for the consumer. You talk about outlawing fracking, or if a certain constituent gets a hold of policy through this election, and then the next thing you know, we're outlawing fracking, certainly on federal lands, and then the next thing is private lands through the water, rules and regulations. If the consumer is willing to pay, 3 to 5x for gasoline and natural gas, they don't understand that. They don't understand the ramifications of taking away capital from shale and what that does to their personal pocketbook. We haven't done a very good job as industry leaders in explaining that and describing what can happen. Now, some things that need to happen, we need to eliminate flaring. We don't understand why,
Yeah, and I'm with you. I'm 100% with you. That one.
You shouldn't flare your wells.
Shouldn't flare your wells.
Very easy one. Take it. When the economics of that play justify spending the pipeline money to access and capture that gas, then that's good. Then that's when that project needs to be developed. But there's no excuse really for doing that. So I think that has been a public relations nightmare for us, which is, you have guys that are taking satellite images of flaring and then blasting it throughout the world and say, here you go. These guys are the culprit. This is what's causing it. So I think we do a better job, and that's an easy, low-hanging fruit right there to tap. Tailpipe emissions, all those things. Ultimately, those electric vehicles will take a bigger and bigger piece of the stack, but it's not anytime soon. And so we've got to figure out a better way to articulate the benefits of our industry, the benefits of reliable, clean, abundant supplies, which keeps prices low for consumers, which is allowing them to grow their wealth and travel wherever they want. The Green New Deal.
Assuming we get to travel again at some point.
Yeah, at some point, other than just a car with your family,
Right.
But that's why, it's just let's talk realistically, and let's stand up and talk about the benefits, not just the downside to our industry.
Yeah, I really hope that coming out of this pandemic that society does a better job of understanding trade-offs, because it's really easy to see what's right in front of your face, which is, I'm worried about something. So we were worried about the coronavirus, so we shut everything down. And there were a lot of people who were saying, but hold on, let's look at the trade-offs of the impact on business, and not just business, but more importantly, jobs and tax revenue. And I saw that New York State expects that their income and property tax will be down 40% this year. And when you start running that, what does that mean for future taxation, social services? And so I hope that the thing that people think about more is everything in life is a trade-off. Getting married is a trade-off. Having kids is a trade-off. We're all used to doing that in our personal lives, but somehow when it comes to policy discussion, we think that we can have our cake and eat it too.
It's cost-benefit analysis on everything that you do, and do our best to have as limited of a carbon footprint as we can, but maximum employment. We're here to provide as much benefit to people that we can, and don't just focus on, that your greenhouse gas emissions ticked up and therefore the world is going to end. It's not going to end. We've seen this over the history of climate. Let's be realistic and let's figure out how best to support humans on this planet and do our best to keep our footprint as minimal as possible.
So last word question for you, and you sort of touched on it a little bit around the high cost, low cost consumers, but the Tuscaloosa marine shale is something that the TMS, people probably haven't heard about it since 2014. It was sort of a big oily resource play. Give us the sort of 2-minute, I mean, obviously prices are different, but give us the 2-minute sort of overview as to why you liked it, the work that was done to sort of appraise it, and sort of why it's sitting ready to go when prices evolve to whatever level they need to make it work.
Yeah, so great. I'm glad you brought that up. So the resource is there. I mean, when you look at wells, even though they were not completed with current recipes, so for example, the biggest proppant amount that we pumped was 2,000 pounds per foot over a 250-foot interval. And yet we still hit exactly where we thought, our type curve, which is about 700,000 barrels. What took that play down when oil prices went down was variability on getting your wells drilled and completed without any train wrecks or hiccups, so because...
And is that because of overpressure? Is it a really high pressure zone?
It's partly because of overpressure. It's a highly fractured reservoir. There were certain drilling issues where basically the rock would slough into your wellbore because it was unconsolidated and you would get stuck while drilling through it. So figuring out a way to get through that, and we finally did, and then oil prices collapsed. So we quit drilling. But coming in at a steep pitch and then going horizontal kept us wellbore stability much better than the earlier wells. So that was one thing. And then on the completion side, the rock is a little softer. And so designing your completion such that you kept the clays from swelling. When they swell, it basically is like a balloon, it goes up and then it comes back down. You need to bust that rock up. We finally figured that out too, the proper recipe on how to get these wells properly stimulated. I think the reason we maintain 30-something thousand net acres, all held by production in that play, is because that play will have its day again. There's just too much oil there. And so coming back in with a new completion design, more modern, tighter intervals, a little more proppant per foot, is going to make even better wells over and above the 700,000 BOE curve. And then now through drilling techniques and completion techniques, we think we'll make better wells for lower cost. But, we'd like to see, $50 oil before going back into that play. But for us, it's also going to have to fit within our Haynesville economics, which are off the chart right now. So it's why we haven't allocated any capital there. We do have 2 drilled but uncompleted wells, 2 ducts that ultimately we can go out and complete. But again, it's got to compete with 100% IRR at 250, or we're not gonna go spend the money.
Yeah. So you have a time machine, and you can go back 25 years, just because it happens to coincide also with Goodrich going public. And you get to meet the younger Rob, less experienced, probably less good looking as well, to be honest, and not as well dressed. And you're going to give Rob some advice that, over the course of the last 25 years would have been maybe a game changer in terms of something. It could be personal, it could be work, it could be anything. What would you say to yourself?
Well, I would tell this generation that's 25 years younger to wake up every day trying to learn and conquer the world. And I don't see that with a lot of the younger guys. You do see some differences among the peers, but I just remember every day And Gil Goodrich and I basically started this back in 1995, and we were always trying to build something here. And it wasn't just for wealth; it was just, that's what we were. That was in our DNA. And so the 25-year younger generation, I'm not sure is quite as hungry, although some guys are exceptional and they're doing extremely well. But as a group, I would say always keep trying to learn, because things change in our industry daily almost. Try to understand the macro as early as you can, because everything is about supply and demand, and it's not just domestic. In particular for oil, you got to understand Middle East and oil production throughout the world. So I think that's important. And then get as much finance training as you can, because keeping a balance sheet in decent shape. Accountants can always track where you've been. It's the financial executive that's telling you where you're going, which is extremely important. So I think if you can combine all of those things, but don't lose aggression, get up every day trying to do a deal or make something happen, I think that would be the advice I would give people.
Love it. Well, Rob, I really appreciate you joining us to talk about Goodrich. I think it's a very interesting story, and it sort of probably went from a 2019, what the heck are you doing in the Haynesville, to, oh my gosh, 2020, we love the Haynesville.
Okay.
So congrats on finally getting to have your day, and I wish you and the company the best of luck in the post-pandemic, and look forward to catching up with you again.
Thanks, David. Really enjoyed it. Take care.
Until the next time, this is the Hot Take of the Day podcast. You can write a review on iTunes if you're bored and you just want to communicate with the world in a random social media way that probably won't get you in trouble with your employer. Say how great we are and how much you learn. Until next time, be safe, be good, have a great day, and bye for now.